So we are going to kick off this morning's summit then with a keynote speech. So please join me in welcoming on stage to talk about not letting hype break you too. It is the general partner from Silicon Roundabout Ventures, Francesco Perticarari.
All right, everyone. Now, we had all this hype about how good we are as investors. Now I'm going to tell you that maybe finance just broke innovation. That, to me, means equating to the question to ask ourselves, could 4 years from now, trillion-dollar companies be much more likely to come from an obscure spot in, let's say, the middle of Poland, from an obscure PhD, than they are to become from the Silicon Valley AI gurus? About me, I'm Francesco Perticarari, general partner at Silicon Roundabout Ventures, focused on researching these deep technology trends and hopefully backing entrepreneurs in these technology companies after co-founding and running what's become the largest deep tech meetup community in the UK and a career in computer science. Now, VC, the problem of VC is that it seems like we're acting more like a functioning alcoholic than an actual healthy industry. And the reality is that you can start to see, for instance, how in the US, just last year, 75% of all of venture capital raised ended up only in just 30 firms. And the problem of these cycles is that what do big funds do with big money? Well, they write bigger checks. And then bigger checks demand bigger rounds. And bigger rounds demand bigger valuations. And so irrespective of any shift in or progress in fundamentals, these valuations demand bigger and bigger stories. And these bigger and bigger stories come to you from the media, and they basically create this FOMO behavior. So the more capital goes into these big funds that then write bigger tickets. And it seems like a self-fulfilling prophecy that only goes into one direction. Just to take one as an example, you can just look up at what Sequoia invested in last year, one of the big names out there. And the reality is that you would only pretty much fund AI software. Because, of course, what are we investing in today seems like AI software. But you step back a couple of years, and the same firm was one of the biggest believers and backers of FTX. And, of course, we know how the metaverse ended there. And, of course, it just seems to be a pattern that repeats. It was B2B SaaS, it was e-com, it was delivery. And it's not Sequoia to be picking on them, to be fair, because you just take any random one of them and look at the latest news, who is raising $8 billion for an AI strategy, who is telling us the AI will save the world, who is, after burning a bunch of billions during 2021, is back again raising billions for this AI cycle. But you might want to ask, what about exits? We're talking about raising, what about what comes after? Well, the point is that you might think, well, with AI, it will be different. I mean, the AI is not the metaverse, right? It's not deliveries. And you need big money to take big leaps and, buy a bunch of GPUs, right? Right? Sam Altman says he wants to raise $1 trillion. Must be true, right? Well, then, of course, we know Deepseek came along. And whether you agree or not on how they calculated about 6 million versus 20 to 100 million training, the point is not depends on training a model. The point is that Deepseek reminded us of something that really was always in front of us. You just look at history, you look at the history of the biggest tech companies, and not just any random one, like the top ones. And you will notice that Apple, Fairchild Semiconductor, that really created venture capital in the industry, or Nvidia, or Amazon, they all got started with about $1 million, a few $100,000, even accounting for inflation, that's basically less than $10 million in today funding. And not only they were raising this type of rounds, but also they were not riding a hype trend when they got started, where everybody was looking right where they were. Jeff Bezos remind us that he had to basically fight to get a bunch of angels to believe in him, and they were asking questions such as, what's the internet? So if spotting lean underdogs is what really makes venture capital great, well, then that doesn't grow AUM. And, looking at Sequoia, it seems like I'm picking on them. I'm not, but just to show the growth, if the fund that backed NVIDIA, estimates because we don't know for sure, but was in the tens of millions, low tens of millions, and their first fund was 3. And again, that created all of these titans that are literally dominating the top spots of the stock market today. It's very different from the fund they're running today. And so if the whole industry is obsessed about, someone like them, not necessarily them, but like backing your next company and backing the next industry and trend to tell us what the future looks like, well, perhaps that whole circle of how the venture capital industry seems to be working now doesn't really align with that thought. And so what potentially could be worrying is that if 9 firms control half of all the VC raised in the US, which globally accounts for the majority of venture capital, and you look at the stock market, you have a parallel where 7 companies now make up over a third of the entire stock market, then collapse isn't a risk, it's basically arithmetic. I mean, you then start to look at debt to GDP, and we might be pretty high compared to historical standards. Stock market price to GVA, gross value add, actually we're the highest it's ever pretty much been. And of course, the price to earning ratio also points us that we might be in bullish territory. So, realistically, we're here talking about investments, but we might have just passed the peak. And in fact, we might be heading towards a recession. And now, if that's true, then what can we do? I mean, we can keep partying like it's 2000 and 2006 or 2021. I mean, this time will be different. I mean, it's AI, of course, it's going to be different, right? Or we could panic. We'll do what grandma says and stash the cash away and not invest in anything, or just sort of, withdraw and wait for the world to change. Or is there anything else we can do? I guess that question could be rephrased in what is value? Is value just a function of who else is investing and who else is gambling on something? Or is there a deeper measure of value that we as investors can look for? And I want to quote someone that in venture capital normally people don't hear about. This gentleman, James Anderson, took a fund in remote Scotland, Highlands based, and outperformed the Nasdaq for over 20 years, achieving some stellar results, maybe one of the best investors that we've had in Europe ever. And he mentioned something when he departed this fund that said, most investors actually do not listen to experts. They listen to the media. They listen to the hype. And that creates all of these fluctuations. But reality is that they should be focused on the underlying value. Now, if value is, let's say, the long-run free cash flows that has enabled his portfolio to create such an enormous performance over the years, can anybody guess what those charts are representing? It's one of the companies he backed. Pretty famous one. Anybody? I'm going to give you a tip. The top one is revenue. The second one is price, is the actual company performance. And the last one is the index is priced on. Any guess? Better now? Yes. So now, the interesting thing is that you can't really zoom into this part, but you would notice that these little things are just as dramatic as the swings there. The interesting point is that despite what investors, public, private, might want to believe, Amazon just kept on going. I mean, revenue just kept going up, eventually profits, and that kept going up, and it keeps going up. And it seems like completely unaffected by what investors might believe the next hype or the past hype is going to be. And so whilst the price of the stock swings and whilst the stock market swings, Amazon just kept on delivering. However, when they started, it wasn't that obvious at all. In fact, the mainstream investors at the time were not even sure that Amazon was ever going to make it, calling it Amazon.com, for example. And so if the point of what we should be doing today as investors is not asking ourselves whether the AI is the thing to invest in, or whether that other trend is the thing, or whether that investor is the one to follow or not, but actually finding new trillion-dollar contrarian, lean, and underserved founders and champions, then how do we find them? I'm not here to tell you, specific new trend to replace AI with, but I guess I could give you some, tips at least to think about. I mean, if you're looking for contrarians, well, Europe has been the unloved child of venture capital for so long that, if you're looking for contrarian, perhaps it's a market worth exploring, because the reality is that Europe has created some amazing technical excellence over the years. And then, of course, even though the majority of investors still seems to be focused on software, the reality is that deep tech and hard technologies have been proven to be much more capital efficient than even software companies, because, again, capital spend doesn't equate capital efficiency, and even though it's growing within the venture capital landscape, it's still relatively niche. There are abundant opportunity of disruptions in unloved industries that your typical big investor wouldn't touch. Again, ABB, it's a company that everybody knows in industrial automation. It's been generating billions for 2 centuries, and nobody has ever tried to disrupt them or back the disruptors. Of course, we all know that Moore's law is towards the end. In reality, it's already ended, but GPUs have shifted the compute power into a different paradigm. But of course, as they did, another one will come by the time their cycle will be over. Or we can look at space launches dropping in price over the years, and that continuing to be a trend. We could look at what happened in Ukraine, where drones and forms of new types of software orchestration took down military equipment worth millions. We can look at quantum computing, where the number of qubits just keeps rising year after year after year. The number of qubits needed for computation of something useful is coming down thanks to research. We could look at energy consumption, that despite all the greenwashings and all of the investment in renewables, the reality is that the demand for energy has grown so high that actually fossil fuel consumption has also grown higher. And so I just want to leave these ideas out there for you to think about. The point that I really wanted to drive home is this Warsaw PhD blueprint. I mean, don't just go buy a ticket to go to Warsaw. The point is not Poland specifically. The point is that perhaps as investors, we should be less concerned of what's happened over the last 20 years and about who is investing, who are the co-investors, what's the logo there, what's the time slide, what's the hype trend that we should be following, and maybe obsess over the specific entrepreneurs or fund managers that are looking for something that is a little bit out of the radar, that is a little bit contrarian, that might just defy what the press is telling us is what we should be concerned about, and perhaps avoid mistaking hard, difficult, unloved with inefficient, because the two things, if you look at data, are not the same thing. And then, of course, we should potentially want to replace FOMO with what I call FUND, i.e. fear of not daring. The question you might be asking yourself then is maybe not whether you should be missing out or not missing out, but whether you're daring enough. Because the reality is that if you have enough of a groundbreaking technology and willingness to expand to, say, the US, which is still, the motherland of venture capital, a couple of German, Turkish scientists can create a company that can really solve a global pandemic, and we've seen it happen. So then perhaps the next NVIDIA won't scale with GPUs like all of the big fundraisers and big funds are telling us will, but it might be built by a PhD somewhere in a lab, somewhere away from the hotspot of the VC map, and working on a problem that is big and that is difficult, but that incumbents already abandoned and that big VC trends are not following. And this person or these people might be just ready with a backpack half packed, ready to jump on a plane to go where the clients are, where the opportunities are. And I think that rather than listening to the hype and the media and worrying about crisis or not crisis, our job really as investors is to find them. Thank you very much.